Welcome back. Traders and investors have been eagerly waiting to hear the one man who knows the impact of the FTAs and tariffs on Indian textiles best. He's my guest today, Mr. Sivaramakrishnan Ganapathy, the Vice Chairman and Managing Director of Gokaldas Exports.
Thank you.
Mr. Sivaramakrishnan, thank you very much indeed for joining us in our studio itself.
Thank you for having me.
The most important voice to hear today. First, give us an idea of how have things cleared for you as far as the US is concerned. Are your buyers queuing back?
I think there's a sigh of relief everywhere. You know, we were the sort of 50% tariff, the penal tariff of 25% was hanging over our head. And, you know, there were concerns that if it continues for long, you know, people will have to look at alternate sources for buying their products. And, you know, we soldiered on for about 6 months,
Yes.
Made sure that the business was kept within India, despite these steep tariffs. We also had to share the tariff burden with our customers, so that impacted us on our margins. But we were successful in holding them on. There was a belief that eventually this will give way and, you know, the trade will get normalized with tariff getting normalized. So I think that we're seeing early signs of that. We have, you know, most of the brands telling us that now they will again look at stepping up sourcing from India, which is good news. If you look at 2024, there was a survey done of US retailers, apparel retailers, and they said that in 2025, they're looking at India as one of the principal areas to increase sourcing from. So India was very much in the radar, you know, it was top countries to step up sourcing from, and then tariff hit us. So you know, the whole situation went, you know, topsy-turvy.
But has the excitement returned?
It is returning. It is returning, right? It's early days. We've gone down to 25. You know, we should soon go down to 18. And if that happens, I think, and that should happen, I suppose, then we will see the excitement picking up. It is already picking up steam. What has happened is that, you know, most of the orders for Q1 and Q2 of next financial year is almost booked. So effectively, the change will start materializing from Q3 onwards. You know, spring, summer 27 onwards. That's what we'll produce in Q3 of this year.
Was your Q1, Q2 impacted? Because you were doing those negotiations when 50 was on our head.
Yes.
I mean, can you be reasonably sure that this EBITDA of 76.9 crores is gone for good and you will double it in the...
EBITDA will,
in the current quarter itself?
EBITDA will improve, most likely from next quarter. Current quarter, there'll be an improvement, but, you know, it'll improve from next quarter because, you know, half of this quarter is gone with, you know, higher tariff. So that burden share was there. I think next quarter onwards, we should start an improvement. We managed to secure our businesses regardless. So, you know, we have a full order book for Q1, reasonably full order book for Q2, which is still under works, and we should have that. So we managed to keep the business with us, albeit by trading margins. Margins will return back, so EBITDA will grow. And from Q3 onwards, we should start stepping on the accelerator as far as growth is concerned.
Okay. Now, in the meanwhile, the good news has come in the form of the EU FTA, which we didn't expect so quickly. So what inroads have you made there? And therefore, can you give us a composite growth rate in both revenue and EBITDA for FY27?
So
first Europe.
Yeah, first Europe. So I think, you know, we've been making reasonable inroads into EU. We've been talking to a lot of customers in EU. You know, we were talking in the meanwhile last year. And as we speak, we are onboarding a new customer from EU. So that journey is on. We currently have about 16-17% of our revenue from EU, which was 13% last year, and which was 8%, you know, almost
without the
before.
EU FTA, you all have...
Because we were looking at diversification, and once this FTA came, that in the last 6-7 months is where bulk of that transition happened. And I think that journey will continue. You know, we will stay diversified. As far as growth is concerned, I think, you know, 27, as I said, you know, the real impact of growth will start kicking in from the second half of 27. So 28 will be the bigger growth. But I am very confident that, you know, if you look at our revenue, 12 to 15% is done deal for 27. Anything more than that, you know, will happen in 28. 28 also will be a 28 over 27 will also be in that ballpark.
Okay.
Yeah.
Now, how big a fly in the ointment is this supposed deal with Bangladesh? We don't know the details, but apparently if they put in a lot of US raw material import into their finished good, they get zero tariff.
Right.
What have you heard, and do you feel the heat on the ground?
See, Bangladesh also has zero tariff from EU, which we don't yet have. But we stood our grounds, right? Of course, Bangladesh is much bigger in terms of exports to EU, but we have our niche, our product capability, etc., which where we don't compete with Bangladesh. Likewise, if I look at US, in the past or till recently, we had a level playing field with Bangladesh, barring that 50% penal tariff. We held on our own because there are certain products, we have fabric ecosystem, especially when it comes to cottons, viscose, etc. We have the fabric ecosystem in India where we can turn things around faster than Bangladesh. So there are product types, categories where we dominate. Now, even if Bangladesh gets, let's say, a more favorable deal than us, we can still hold on our own. And what I understand from the government of India is that they're also trying for a similar deal for India. So if that happens, again, we are back to a level playing field. Okay. So am I particularly worried about Bangladesh? Answer is no. I'm glad that, our own situation has improved, that we can resume our business to US, and that growth journey will continue. It's a very large market, right? So,
and you were telling me before we entered that even now, if you use US cotton or yarn in your finished product,
right,
that much is not tariffed.
That is correct. If you exceed 20% of the FOB value, with US raw material, that component is not tariffed.
Okay.
Yes.
Okay. So in any case, we
have that benefit indeed.
Okay. Well, if you can give us some numbers, I know it's a little unfair since things are in the order stage.
Yes.
What may be the growth next year, and what is the kind? You're expecting much more in 28. Give us some numbers.
As I said, 27, I'm looking at anywhere between 12 and 15% revenue growth, and 28 will be about 15% over 27. Okay. That's the kind of revenue growth we are expecting. We have, in this, I'm not factoring in the textile business. There is a merger intended of BRFL Textiles.
Yes.
So that I'm not counting in.
The inorganic you're not counting.
Yeah, that's
okay.
right.
Okay.
That's right.
What is the slightly longer term vision? Because we've got this kind of scare. Mm-hmm. Do you think Indian textiles as a whole are scouting for more markets? I mean, there is a spring in the step. Albeit out of fear. So do you think our exports can do much better simply because now we are, we've got a warning?
I think, yes, right? So the fact that we've got a warning made us a lot more agile, a lot more cost competitive. We did whatever we had to do in terms of automation, cost reductions, etc. Right? We had to perforce do it. And that also always helps us stay ahead. And globally competitive. If we are competitive at 50% tariff, obviously, we're much better when it's lower. So in many ways, it was a blessing in disguise. It was a very painful period, but it did indeed help us. What does it do to us? I think, that spring in the step which you mentioned is there, and we should really capitalize on growth opportunities going forward. The one tiny bit is, should we diversify our country of origin so that, we de-risk ourselves from any future
that was going
tariff.
to be my next question.
That probably we should. We already are in 3 countries, like India and 2 countries in Africa, Kenya and Ethiopia. Maybe we would perhaps look at a little more diversification. That wouldn't mean that we are going to compromise on India growth. India growth will continue. And I think we will be adding quite a few factories in India as well as we speak.
So what are your capex plans in terms of amount and geographies?
So next 2 years, I am anticipating our capex plan to be about 175 crores or even more, depending on how the business flow happens. We'll take the call dynamically, but it's in that ballpark or higher.
Okay. And inorganic?
Inorganic is always out there, so difficult to comment on it, but we will be open about it, open-minded about it.
Okay, no, for the simple reason that since you're capturing new geographies, would it mean that inorganic will be more simply because you may find a small exporter or manufacturer who has already made inroads into new markets? So I'm just asking if the pace of inorganic
It could. In the next 2 to 3 years, we might be open about looking at some inorganic opportunities, or it could even be, buying a factory rather than buying the whole business. So all options will be explored, but these are very early days.
And finally, a word on the textile sector itself. We did have some tearful stories about people being let off at the height of this 50% scare. Do you think textile as a sector now, revives more? Will jobs increase?
I think so. Okay. I think so. So I think government has done a fantastic job in concluding trade deals with UK, EU, and now, normalization with US. I think kudos to the government. Now, we should see the impact on textiles. It's a very large job creator, and that momentum will come back. So over the next 3 years, you will see that momentum pick up, creating more jobs as well.
Okay. I'm going over time, but any one ask from the government?
I think make sure that, the US tariff stays where it is. You never know, right? I mean, how South Korea got a 10% increase. So if that happens, I think rest, the industry will do for itself.
Will take care of itself. That's a very nice thing to hear from you. And the fact that it is a compounded CAGR of 15% that you are expecting for Gokaldas itself. Yes. Pleasure having you with us in the studio. Yes. Well, that's it on this very pleasant edition of It's the Economy. We wrap up on Bazaar. Short past is coming.